Hi, and welcome to Chapter 22. In this chapter, we're going to talk about homeowners insurance. So this is a necessary expense for anybody who buys a home. And if you buy a home that's going to have a mortgage, it's going to be a requirement where the bank is going to require that this is purchased, and the bank will pay this usually out of your escrow and put it into your monthly mortgage payments. So when you get your monthly mortgage payment, it's going to be a combination of the interest and principal you owe on your house, your homeowner's insurance monthly cost, and your taxes broken up roughly by month. So you may have purchased a home where the 30-year principal and interest may only be, say, $1,000 a month, but after insurance and property taxes, your mortgage is $2,000 a month. So, the bank really owns your house until you're done paying off your mortgage, and they're going to want to make sure that you have homeowners insurance to protect their asset, because your house is really the bank's until you pay off your mortgage. So that's why they make it a requirement that you have homeowners insurance. Now, homeowners insurance is meant to protect and compensate you for any damage to your home. Now, depending on where you are, homeowners insurance can be different. And depending on what company you're going with, the policy can be different as well. Now, the Insurance Service Office, the ISO, is, they're widely used in the United States. So they're designed for owner occupants of family dwellings is what their specialty is. So a policy can be used to cover the house, any structures around the house like a deck or a pool, personal property within the house, additional living expenses if you need to relocate while the house is being repaired, personal liability claims if you're hurt in the house, medical payments to others if they're hurt in the house or around the house. So these are just some basic things that the homeowners insurance would cover. Now, it's broken up into what we call HO2, homeowners 2, and HO3, homeowners 3. This can go all the way to HO8. So let's talk about HO2 and HO3. So HO2 is a sort of a catch-all form, and it's going to name the particulars of the policy that are going to insure the dwelling, and other structures. For example, other structures could be a tool shed, a deck, a garage that's detached. So it's going to cover what we call the perils of home ownership, such as fire, lightning, windstorm, hail, explosion, and other types of perils that are going to be listed and covered under the Homeowners 2 section. It's also going to cover any additional living expenses at fair rental value in the event of a loss that makes the dwelling uninhabitable, which, if something happens in the house where it's unhealthy for you to be there or unsafe, then they would pay for additional living expenses if you're going to rent something temporarily. Now, the HO3 is what we call a special form, and it's going to insure the dwelling and other structures against direct physical loss of property. So that means all direct physical losses to the dwelling and other structures are going to be covered, except those losses specifically excluded. So they, in the contract, they can specifically exclude certain losses. And, as far as your compensation, it can be paid on the basis of a full replacement costs with no deductions or depreciations if certain conditions are met. So it's going to cover the same broad forms of perils listed in the HO2 policy. Okay, so let's go to HO4. So HO4 is another broad form like HO2, and it's designed for tenants who rent apartments, houses, or rooms. So homeowners 4 is going to cover the tenant's personal property, against loss or damage, also provide personal liability insurance for these people. The personal property is going to be covered with the same perils that are listed in HO2. In addition, 10% of the insurance on the personal property can be applied to cover any additional alterations to the building made by the insured. So although most renters need homeowner policies, so if you rent or if you rent an apartment, a condo, or co-op, you should have your own renter's insurance, which is going to protect your personal property inside of your apartment. Most people who rent don't bother with this type of insurance, even though it can be relatively cheap, maybe $200 a year. So the homeowner's policy, however, is especially valuable if it's going to, also contain provisions for tenants. Especially if there's a case where there's fire and belongings are destroyed or water damage, and the cost of replacing furniture, computers, electronics, TVs, this would be covered. And usually there could be a minimum, like they'll cover anything over $5,000 in losses. So it depends on the policy. Additional living expenses will be paid if the rental apartment is no longer inhabitable. So this is pretty useful depending on what you're using your house for. If we go to HO5, this is a comprehensive form. So the homeowners, this form is going to insure the dwelling and other structures and personal property against physical loss to the property. So the provision means that all direct physical losses are covered except those losses specifically excluded. So there's always a fine print in these contracts that you have to look at. They can exclude certain perils or certain items that won't be covered in case of a total loss. So you need to know what is and what isn't. So unlike the other homeowner forms that cover personal property, only for certain perils, HO5 insures personal property for all direct physical losses except those specifically excluded. That's why it depends on how the contract is written and what the insurer wants to insure. So you have to be very, very careful of that. Now also, if things are, you have to also prove that you own these things. And the best way to prove that is, of course, to have a receipt. I would say best thing to do would be have a picture and a receipt of the item in your home. Keep the receipt in a secure location, so that way you can authenticate your ownership of something after, if any damage has occurred. All right, so let's move on to HO6. So HO6 is designed for the owners of condominium units and cooperative apartments. So this is if you rent anything you rent in someone's house, in an apartment building, in a co-op or a condo, you have to get renter's insurance. However, if you own a home, you need homeowner's insurance. But if you own, it's possible that you can own a condominium or a co-op. Co-ops are popular in cities. You're going to need HO6, which is going to be designed for people who own these other types of dwellings. Now, generally, if you live in a co-op or a condo, there's going to be some insurance that the cooperative or condo has on the building and other property owned in the common areas of the property. However, the HO6 is going to cover your personal property in your unit for the same perils listed in HO2 that we talked about. In addition, there's a minimum of $5,000 of insurance on the condominium or co-op unit that's going to cover certain properties such as built-in appliances, carpets, kitchen cabinets, and wallpaper. So, basically say your co-op structure building burned to the ground, the co-op association would have the responsibility of rebuilding your co-op unit, but it would not cover any of the fixtures or personal properties inside your unit. So that's why you need separate insurance for that. Okay, moving on to HO8. There is no HO7. So HO8 homeowners, this is a modified coverage form that's going to cover loss to the dwelling and other structures on the basis of repair costs. which is the amount required to repair or replace damaged property using common construction materials and methods. So this is a little bit more specific. So it's looking at, if there's something damaged, not just giving you the full brand new cost or buy you a brand new item. They're looking at what the payment would be based on repair. So this is definitely going to save the insurance company money if they're only going to pay for the repairs to a certain thing and not full replacement of brand new. So it's designed for older homes where replacement costs substantially exceeds its market value. So for example, in an older home, the replacement cost of $300,000 may have a market value of only $200,000. So insurers will not insure a home for replacement costs when the current market value is substantially lower. So to make the homeowners cover available for older homes and to reduce moral hazard, the HO form was developed. So it's a policy that limited coverage for, so really only limited the coverage for the theft of personal property. So theft is covered under a maximum of $1,000 per occurrence and applied to losses that occur at the residential permits. So this again is something looking at, there can be a situation where the cost of rebuilding your home is less than the actual value of the resale of the home. So this is sort of a modified insurance for that particular scenario. Okay, so let's look at comparisons of ISO homeowners coverage. So if we look at the coverage, we can break that out between dwelling, other structures like patios, decks, sheds, detached garages, sometimes pools, personal property, that's the stuff you own inside your house, and loss due to use. Okay, so those are the four main categories. So in the HO2 broad form, there's a minimum. The minimum varies by company as far as the coverage. And then for the other areas, it's going to be percentage of assets. And you can see how this is the same for HO2, HO3, but HO4 is going to be significantly different because in HO4, it's designed for tenants who rent. So these dwelling structures are not going to be applied if you rent a property, but the amount of your personal property and the use, the loss of use, which means that if you can't live there, what's going to be the total coverage, and it's going to be a percentage of the asset. And if we look at the perils covered by policy, we could see that HO2, the broad form, is going to cover a lot of perils that could potentially happen. And the specialty HO3 is going to be a little bit more refined, and HO4 is just going to be personal property because this is the renter's insurance. And remember, the HO3 is going to be insure the dwelling and other structures against direct physical loss of property. So it only has to really be concerned with these forms here of coverage. So if we look at HO5, 6, and 8, remember this, we're not covering 7. You can see that they have a similar, HO5 is similar, 10%, 50%, 30% of structures, property, and use. Now when you look at HO6, remember this is for co-ops and cooperatives. A co-op, what's the difference between a co-op and a cooperative? A cooperative is you own shares of the property. So the property is like a company, and you own shares of stock in that property. That if you buy a unit in that property, a cooperative unit, you get X amount of shares associated with that unit. A condo is more like a house. You actually own the condo and you own the property. You're not part of a cooperative. So there are different types of ownerships. The best type of ownership is an individual dwelling, like a house, then a condominium, and then a co-op. So co-op would really be the weakest form of ownership, and typically with the slowest amount of appreciation of the asset. But anyway, this is why this is broken up differently, because you don't have to worry about structures or really dwelling so much, but personal property and loss of use, yes. The HO8 we're going to have a 10-50-10, and this is going to be as far as the perils covered. This is the small list of perils covered on the HO8. And now if we look at Section 2, the minimum amounts that can be increased. So we're starting at, for personal liability, $100,000, which can be increased if you want to pay more, and medical payments to others at $1,000 per person as a starting point. For 5, 6, and 8, it's the same. Okay, so let's look at homeowners 3 policy, persons insured. The following people are going to be considered insured under your HO3 policy, which is of course going to be you and your spouse if you have one. Any resident relatives, brothers, sisters, children, other persons under age 21, full-time students away from home. So if you have your homeowner's policy will cover your child if they are studying away from home and they have loss of property. So the coverage under Section 2 is also going to cover any person legally responsible for covered animals or watercraft. And this is respect to a motor vehicle covered by the policy, like a riding mower, not a car. If a car has its own car insurance, the car insurance is going to come first. You're not going to look to your home insurance to cover anything on a personal vehicle. But that's what's going to be. Now, when it says other persons under age 21 over here, what exactly do they mean by that? Well, other persons under age 21 who are in the care of the named insurance or the care of the household resident who is a relative are covered. For example, a foster child, a ward of the court, a foreign exchange student. So these are what they mean by other people. Now, this might be interest of you since many of you might be full-time students studying away. So if your parents have home insurance, then you as a full-time student studying away from home who is a resident of the university or on campus or maybe even off campus, you're going to be make sure that your name is on the household policy before you attend school, provided that the student is under age 24 and you are a direct relative of the person who owns the house. You're underage, or if you're not a direct relative, you're under age 21 and you're being taken care of someone who's a relative of the house. And that what basically means is that if you do want to incite your homeowner's coverage, you want to make sure that your parents have you named in the policy, so that way if anything does happen at college, and this is just limited to personal property like loss or theft of a laptop, you could be covered. Now, if we look at Homeowners 3 policy Section 1 coverages, we talk about coverage. There's coverage A, which is dwelling, which we're going to talk about in a second. Coverage B, other structures. Coverage C, personal property. Coverage D, loss of use, and additional coverages. So if we talk about coverage A, coverage A is going to be the dwelling on the residence premises, as well as any structures attached to the dwelling. So this is going to be basically the home, and anything else around the home that's a structure is going to be covered for any damage that's led to it, specifically to the perils associated in the policy. Now remember, land is not going to be covered. So if your land is destroyed by a sinkhole or some kind of river coming through, it's not going to be covered by your homeowner's insurance, because your homeowner's insurance is meant to cover your home, not the land around your property. So now when we talk about Part B, other structures, specifically, these are things that can reside on your land or property. It's not attached to the house. That would be covered here, such as a tool shed is pretty common, a deck, possibly a pool, depending on the policy. Now, if you're going to rent any structures like a garage, it's not going to be included. You need to have a separate business insurance for that. And the amount of insurance is going to be covered as a percentage of the base and covered in Part A. Let's talk about C, personal property. So personal property is a big one. And again, these are things that you own that's going to be insured by your policy. Now, it could be covered anywhere in the world. So the provision also includes borrowed property, in addition, after a loss, and at the name insurance request, insurance can be extended to cover personal property of a guest or a resident, employee, within the property of the residence occupied. For example, if you invite somebody over, and the guest has a very expensive fur coat and it burns up because it was placed next to the fireplace, this can be covered under your policy. So there's a lot of stuff here. It's going to be a percentage of your total coverage in Part A of the dwelling as a maximum. And these are things that, you could have some very expensive things in your house. You could have some, collectible artwork. You could have some jewelry. You could have some electronics. These things that could cost a great deal if they need to be replaced. Now, any item that is specifically very expensive, you might want to get separate insurance for. So if you have like $1 million masterwork piece of art, it's not going to be fully covered on your homeowners because your homeowners is going to be a percentage of your policy. So if it's going to be limited to 10% of your policy is for $300,000, it's only going to go up to $30,000. So you have to be careful of those percentages and how they're applied to your policy. So if you have anything of really great value, you may want to get a separate policy for it because your homeowners, there's a limit to how much it will cover. Okay, so let's talk about other special limits of liability. So, and remember, these homeowner contracts are very detailed, and they're there to protect the insurance company. So the insurance company wants to make sure there isn't any really big amounts of liabilities they could possibly be on the hook for unusual situations. So, for example, they have these special limits, such as, $200 for the amount of money you may have in your house, gold or silver or coins you may have in your house. They limit this to $200. So that means do not keep a lot of cash in your house. Do not keep a lot of gold or silver in your house because you're only going to get $200 back on a typical policy. Now, if you have some type of secured valuable papers, such as, personal recordings, passports, tickets, stamps, manuscripts, $1,500 is the limit there. If you have a jet ski on your property, any type of watercraft, a boat, $1,500. So if you have a $30,000 sailboat and you're keeping it in your driveway, you're only going to get a portion of that money back to the total. So you need a separate boat insurance if it's anything greater than $1,500. In trailers you may have on your property, $1,500. Okay, so jewelry, watches, furs, precious stones, $1,500. Now, one expensive watch can be more than $1,500. So that's why this stuff would need a separate policy or a way to increase it on your homeowners if you want to cover more expensive items if you have them. Theft of guns or bullets, $2,500. Theft of silverware, goldware, platinumware, or pewterware. These are up to $2,500. Okay, so let's move to property on the residence premise used primarily for business purposes. You may have up to basic $2,500. And now the limit doesn't apply to antennas, recording discs or other media, and that could be $1,500. Portable electronic equipment, stereos, radios, things like this, we're talking about $1,500. And antenna, tapes, wires, records, discs, other media, CDs, $250. So you want to make sure if you have anything in your house that is going to be, say you have a collectible record editions of vinyl records that are worth $50,000, or you have a set of comic books that are rare and they're worth $10,000. You want to get separate insurance for this. So if you own Superman or Batman #1, in mint condition that's worth $1 million, you definitely would want a separate insurance for that. Now let's talk about Section 1 coverages, and we're going to talk about, a schedule can be used to insure certain personal properties at a specific amount. So coverage C is also exclude certain types of property. For example, animals typically are uncovered. Motor vehicles or other type of crafts that should have its own insurance will not be covered. The property of roommates or other tenants under this section won't be covered. Apartments in your property for rental won't be covered. Property that you may have away from the premise as rent is not covered. Business data is not covered. Credit cards, electronic fund transfer cards are not covered. And also swimming pools may not be covered. So Schedule C, you can exclude. Now, coverage can be modified. Additional insurance or coverage can be modified to cover some of these types of property at additional cost to the homeowner, the insurance policy, if the insurance company will allow you to expand the policy to cover these types of incidences. The insurance company is free to do whatever they want. So if they want to extend coverages to certain things that are typically excluded, they can for an additional cost. Some things, are hard to put a value on. What is the value of your pet? This is typically why they stray away from covering that. Okay, so let's look at Part D, which is going to provide protection when the residence premise cannot be used because of a loss. So this typically will occur if there's some sort of fire damage, maybe there's mold damage, where, you can't live there. So this coverage is going to be limited to 30% in coverage A. Coverage A is typically the dwelling, the value of the home. So additional living expenses equal to what the family standard of living is. So one way you'd look at this is if you are used to living in a 3-bedroom home, then you rent a 3-bedroom apartment, that would be equal standard. Now, so they don't expect you to have to rent a studio if your house is unlivable. So that's why we say maintain the family standard of living. Now, so that would have to be really discussed and negotiated with your insurance company to make sure that wherever you're staying in temporary housing, they will consider it maintaining your standard of living and then also compensate you for it. So you want to talk with them before just assuming. Now, the policy pays a fair rental value as part of the residence that is rented to others, but it's not fit to live in. So if you had a rental property that was a legal rental property and you weren't able to rent it any longer or for a temporary period while it's being repaired, they can compensate you for that too. So coverage applies if the home is not damaged, but a civil authority prohibits the insured from using the premise. For some reason you're not. So the house could be perfectly fine, but maybe there's some kind of toxic waste spill nearby that would prevent you from living in the home. They could cover that until it's cleaned up. Some additional covers in Section 1, removal of debris from an insured peril, meaning that say there was a lightning and it struck a tree and they have to remove that tree. Reasonable repairs to protect the property from further damage. So if there is a situation where if you don't build up a levee, your house is going to be swept away by the river, they may cover that. Trees, shrubs, and plants for a limited set of perils, and that's specific to the policy. Fire damage, as far as the fire department service charge. So if the fire department comes to your house because there's a fire, they may charge you a service charge for putting that fire out. Insurance company will cover that. Removal of property that is endangered by an insured peril. So there's a structure in your property that could collapse and hurt somebody. They'll remove that and pay for that. Unauthorized use of credit card, electronic fund transfer, forgery or counterfeit money. So if someone uses your credit cards without, so maybe your house was robbed and they stole your credit cards and then used them, they'll cover that. But first, in that instance, they'll look to the credit card company to cover that. And if the credit card company doesn't cover it, then the homeowner's insurance. So there's always an order of what insurance company covers what first. And it's typically, the closer you are to owning or managing another piece of financial product or asset, then that insurance company is going to have to go first. So, for example, if a car is damaged on your property, the automobile insurance has to be contacted, and they would have to cover that loss. Now, if your homeowner's policy also covered automobiles on your property, then they would come in after and cover whatever the auto company doesn't cover. But it's very rare for homeowners insurance to have automotive coverage on your property, because you're supposed to have separate coverage for that. Okay. So let's look at the, continue with this, loss assessment charged against the name insured by a corporation or association of property owners because of direct loss of property collectively owned by members. So this is more for, co-op or condo. And so if there's a loss that's going to be charged against your property because of something that happened, the insurance company will cover that. Collapse of a building on your property, breakage of glass or safety glaze material, which is like a safety glass, they'll clean it up, pay for that. Landlord's furnishings, increased cost of construction or repair because of an ordinance of law, meaning that the town came in and said you have to install these safety windows or something because it's a new law. They would cover that. And any grave markers on your property, which is really gruesome, but some properties do have grave markers. Okay. So, continuing with homeowner policy 3, section 1, perils. Now, so the dwelling and other structures are insured for all direct physical loss unless specifically excluded. So some common exclusions would include collapse, freezing, fences, pavement, patio, or similar structures, dwellings under construction, vandalism, mold, fungus, dry rot, wear and tear, mechanical breakdown. So these are things that your policy can specifically exclude. Not all policies do. That's why it's important to read your policy to figure out, is it included or is it excluded? So personal property is insured for a direct physical loss if it's caused by one of the perils listed in the policy. So the peril have approximate cause of the loss. So just because there was a lightning storm, but the lightning didn't strike your house or strike your property, you can't get something fixed because there was a lightning storm. Or, for example, a hurricane's a special event, but a hurricane usually has its own specific deductibility. But if your house was damaged for something else and a hurricane rolls by, you can't use the hurricane's excuse to fix your house. Okay, so named perils typically include fire, windstorm, hail, explosion, riot, civil commotion, aircraft, vehicles, smoke, vandalism, and falling objects. So it has to be, you have to be able to tie these events to the damage of your house if you want it to be covered. So coverage for theft is pretty broad, but there are some exceptions. If the theft is caused by someone who's insured on the policy, if the theft in or to a dwelling is under construction, if the theft is from any part of the premise rented by someone other than is insured. So these are some exclusions you should be aware of. So basically, if there's theft, if you're renting an apartment for this last one, if you're renting an apartment to somebody and there's theft in the apartment, the person who's renting the apartment is responsible for that, not you. So they should have their own renter's policy. So let's look at some policy exclusions in this slide. Start with the concurrent causation losses. So the homeowner's policy is generally going to contain some sort of language to address this. So the exclusion means that if a single loss is caused by two or more perils that occur at the same time concurrently or in a sequence one after the other, in the policy, in the particular one of the particular perils is covered by the policy, and the other peril is excluded, then the entire loss is excluded. So basically, if your policy, because they can't really tell which of these perils caused it. So if two perils are going to concur at the same time, this can create a serious loss adjustment problem. So, thousands of homes can be destroyed by, wind and flood. So, but if those losses are tied to a hurricane and you don't have specific coverage for a hurricane, then you're not going to get the money for the flood or the wind because it's tied to that hurricane that's a concurrent cost. Or if typically hurricane coverage would be a percentage, or a fixed deductibility. So maybe you have a 5% deductibility of your total dwelling for hurricane, and it concurs with other perils. All the other perils are going to have to be under that hurricane provision, which is not going to be as generous as the typical provisions for, say, windstorm or, lightning by itself. So losses due to earth movement. So what is an earth movement? That's typically an earthquake, or it could be something from a volcano or a landslide or a mudslide or a sinkhole. So this is typically excluded from your coverage unless you specifically buy earthquake insurance or earth movement insurance. So if you live in an area that's prone to mudslides or earthquakes, you should get separate insurance for that because your policy probably doesn't cover it. Certain water losses. So water damage is pretty common for most places. And the following types of water damage losses are usually not covered. Floods are not covered. You have to get a separate type of insurance for a flood. Water that backs up through sewers or drains. Water below the surface of the ground that seeps up into the building. Waterborne material carried or moved by a stream that damages your property. So since water is so common, they typically are going to really limit the situations where that would be covered. Now, losses due to a power failure or a faulty design. So if there's a power failure that takes place, for example, you have that power is maintaining valuable things inside of a freezer that thaw out, or these things are probably not going to be covered if your power fails and something gets damaged because of lack of power. It's not going to be covered. Losses due to neglect or intentional damage. So if you just neglected to properly take care of something or you intentionally damaged it, of course, it's not going to be covered. Losses due to war, government action, nuclear hazards are not going to be covered. Loss due to certain weather conditions. So this is going to apply depending on, some weather conditions, which could be maybe a landslide due to excessive rain. It could be a avalanche due to excessive snow. These are some things that may not be covered. So you want to know that's why you need to know your policy. Okay. Now let's look at conditions. So the liability insurance for loss is limited to the insurer's insurable interest at the time of loss. So there could be a deductibility that can apply to any loss covered in Section 1. So this deductibility, just like it means that you're responsible for this amount of money that has to be covered first, and anything above it, which will be, they'll cover. So premiums can be reduced, of course, by increasing these deductibilities, specifically for things like hurricane insurance. So if you have a $10,000 or $20,000 deductibility in your hurricane insurance, $50,000 deductibility in your hurricane insurance, your policy costs are going to go down. So if you're vulnerable to certain natural catastrophes where you live, they're probably going to use a percentage deductible. So if you live here on the East Coast of the United States, we're vulnerable to hurricanes. So hurricanes are typically a percentage deductibility, meaning that if your house is, you have a $500,000 house and a 10% deductibility for hurricane damage, it means the hurricane damage has to exceed $50,000 worth of damage before they'll cover, and they'll only cover what's above that percentage, above that $50,000. The insured must perform certain duties after a loss occurs. So once a loss occurs, you're going to have to give the insurer prompt notice, and that's a time frame set within your contract. Protect the property from any additional damage. So you have to do your best to protect the property from further damage. So say, part of your roof is blown off. It would be reasonable that you put some sort of tarp over the roof to protect from further rain damage. Be able to exhibit the damaged personal property and prove, what you had. Be able to say, okay, here's my laptop. It got soaked in rain. It doesn't work anymore, or it got hit by debris. Somehow you have to prove what's been damaged, and the insurance company needs to see some sort of proof or some sort of visual witness up to what has happened. So you have to file proof of loss within 60 days after your request. So these are things that you make sure you know the proper sequence of how to file a claim once something has been damaged. And that's why it's probably important to keep a homeowner's inventory, where you have an inventory of things that you have in your home. So you have, and the best way to do this is to take pictures, and pictures alongside of receipts. So you could say, here is what my house looks like before any damage. Here's the most valuable items in the house, and here are the receipts to show that these were purchased and they're stored here in the house. And that's going to help you out, because if something happens where there's a fire and you can't really recognize anything in your apartment or your house anymore, you'll have this backup of a homeowner's inventory and receipts to help prepare for your loss statement. It's just, so for this, losses of personal property are paid on the basis of actual cash value. So now this cash value at the time of loss cannot exceed the repair or replacement of the property. So to repair or replace the property is cheaper, then that's what they're going to do. They're not just going to give you the full cash value of it if it's repairable. Now, if you have loss to carpets, appliances, outdoor equipment, they're going to pay an actual cash value basis to be determined by the insurance company. So after giving notice to the insurer has the right to repair or replace any damaged property within the property. So the insurance company makes that call whether or not they're going to repair or replace or give you cash value. Okay, so let's talk about loss of dwelling and other structures paid on the basis of replacement cost with no deduction for depreciation. So that's one thing. Houses typically don't depreciate, they appreciate. So houses don't go down in value too often. So that's why we don't want to have any deductions for depreciation, because depreciation really doesn't make sense for most real estate. So if your dwelling is insured for at least 80% of the replacement cost at the time of loss, partial losses will be paid in full. Replacement cost is the amount necessary to repair or replace the dwelling or materials needed to keep up the quality of the current structure. So that's important. So what you have to realize is just because you have homeowners insurance does not mean that 100% of if your house is completely destroyed, that they're going to pay 100% to rebuild and replace the house. You may have to bear some of those costs. So a calculation, so if the dwelling is at 80% of replacement cost, then the actual cash value of the part of the building would be calculated like this. The amount of the insurance carried divided by 80% of the replacement cost times the loss. So if the loss is $100,000, you're going to get $80,000. So sometimes insurance, don't always think of insurance as going to, help to pay for 100% of the replacement of a lost dwelling or items. Just like in car insurance, if your car is totaled, and they'll give you the value the car currently is, and it may cost you more money to actually buy a new car to replace your car that was totaled. But that's auto insurance. See those chapters for more on that. Now let's look at some insurers will offer extended replacement cost endorsements, which is going to pay the 20% above the policy limit. So you can buy extra insurance to cover the full percent. So unless you actively buy this extra insurance, you're not going to get 100%. Also, a guaranteed replacement cost policy is additional insurance. So the insurance company is going to agree to replace the home exactly as is before the loss if the replacement cost exceeds the amount of insurance. So this is additions you can have to your policy in Section 1 to make sure that you don't have to pay any money to replace your home in case it's totally damaged. So if in the event of a loss to a pair or set, the insurer can either repair or replace any part of the pair or set, or pay the difference between the actual cash value of the property before or after the loss. So, you could have a set of silverware, a set of expensive china, a set of earrings. So if one is damaged and lost or destroyed and one isn't, that's a special case. So it has to be decided that, the full value isn't lost because you have one of the two earrings. They're going to try to either repair or replace the damaged earring or give you the money equal to that damaged earring. So the appraisal clause is used to ensure, used when you agree that the loss is going to be covered and the amount of loss is an actual dispute. So, for example, you say, hey, I lost this valuable collector's item that's worth $10,000. The insurance company says, no, we think that's worth $1,000. You're going to be in a dispute. So the appraisal clause will be helped to settle that dispute. If other insurance covers Section 1, the insurer will only pay the portion of the losses covered by the limited liability bared in the amount of insurance coverage of their loss. So again, there's a pecking order to which insurance goes first. So basically, if you have additional insurance, the primary insurance will pay what they're going to pay. Then the additional insurance will come in and cover the rest. Okay. Now, so no legal action can be brought against the insurer unless all policy provisions have been met. So you can't take legal action unless all the policy provisions have been met. So the policy will have certain provisions that you need to be done before you can bring any legal action against the insurer. This is a way of protecting them against unlawful legal actions or costly legal actions. The insurer has the right to repair or replace any part of the damaged property with like property. So, for example, if your garage is, or say you have something like a water fountain covered, or statue, a statue covered that's covered on your policy somehow and it's damaged, they can repair it or replace it with a similar statue. It doesn't have to be identical. Insurer is generally required to make a loss payment directly in the name of the insured. So if there is a loss, they pay you directly. They don't pay the construction company. They don't pay the business providing the replacement. They pay you directly. The insurer is not obligated to accept any property abandoned by the insured. So that's important. So if you're the insurer, you're not obligated to accept any property abandoned by the insured. So if the insured, the insurance company, if you abandoned something on your property, say you abandoned a swimming pool, the insurance company is not obligated to accept that property or fix that property. Okay. Now, there's a mortgage clause designed to protect the interest payments owed. So this mortgage clause is designed to protect the insurable interest. So a mortgage a mortgage is usually issued by a bank. So this lending institution is going to make a loan to you, so that the property can be purchased. So basically, you don't have enough money to buy the house outright, so you get a mortgage on your property, and the property is going to serve as collateral for the mortgage. So if the property is damaged or destroyed, the collateral security of the loan is going to be impaired, and the loan might not be repaid, because who's going to want to pay a mortgage on a property that is totally destroyed? So the mortgagees, which would be you, insurable interest in the property can be protected by the mortgage clause as part of the homeowner's policy. So in this provision, if the mortgage, if you're named in the policy and the mortgage is entitled to receive loss of payments from the insured, the extent of the interest, regardless of any policy violations, will be insured. Now, why is this in here? This is really something banks want to help ensure that they're going to get interest on their mortgage, on their loan to you. So that's something really, because all these homeowner policies are constructed with the banks in mind. The banks are really keen on protecting their interests in your home because it's their collateral against your loan, and they know that you won't repay the loan unless your property has value. So they do build in these additional strengths into the policies to help protect these banks on principal and interest owed on properties. All right. And keep in mind that any concealment, misrepresentation of any materials or facts or false statements leading up to the insurance will void the insurance coverage. So, so basically if you lie about something, that your house, maybe your house has a dangerous kiln because you do pottery and you don't disclose that to the insurance company, they can void your policy. So you got to be careful of making sure that you provide the insurance company all legally required knowledge that the insurance company needs to know in order for your coverage to be covered. Okay. And finally, we're going to look at sections 1 and 2, conditions. So conditions that apply to both sections 1 and 2 include, the liberalization clause. So what is the liberalization clause? So it's basically if the insured broadens the coverage it offers without charging a higher premium within 60 days before the inception of the policy or during the policy period, the broadened coverage applies immediately to the present policy. However, the liberalization clause does not apply to changes that are implemented with a general program revision that includes both a broadening and restrictions of coverage. So it's just a legal term to kind of protect the insurance company. And one thing they definitely want to guard against is they don't want you to have an incident on your property, get the widened coverage, and then claim against this unusual instrument, this usual damage after the fact it occurred. All right. A waiver or change to policy provisions is going to be a key to that fact. So a waiver or change to any policy provision must be approved in writing by the insurer for it to be valued. Terms and conditions for canceling or cancellation. So if you're insured, you can cancel at any time by returning the policy or by notifying the insurer in writing when the cancellation is going to be effective. And the insurer can cancel the policy under certain conditions. So if you don't pay your premium, the insurer will cancel the policy. A new policy can cancel for any reason if it's been enforced less than 60 days. If the policy has been enforced for 60 days or more, or it's a renewal policy, then the insurer can cancel if there's some kind of falsehood or misrepresentation that you've made that can lead to the insurer to cancel your policy. If the policy is written for a period longer than a year, it can be canceled for any reason on the anniversary of the year. Typically, let's see. Okay, so non-renewal of the policy. The insurer has the right not to renew the policy when it expires, but must give 30 days notice. Assignment of the policy, so the homeowner's policy cannot be assigned to another party without the insurer's consent. So if you sell your home to somebody else, even if it's a relative, you're going to have to, they can't just use your insurance policy for the rest of the year. You have to get it transferred over into their name, or they have to get a new name. Subrogation. So the policy, a general principle which an insured cannot unilaterally waive the insurer's right of a subrogation against a third party who caused the loss without jeopardizing coverage under the policy. So, gotta be wary of that. Extension of the policy terms to a legal representative upon the death of the named insured or spouse. So if the person named in the policy dies, coverage is extended to the legal representation or representative of the deceased, but only in respect to the premises of the property of the deceased. So coverage is also continued for residents who currently are living there or who are insured under the policy at the time of the death of the spouse. So meaning that just because your wife or husband died does not mean the policy is immediately dissolved. There is an extension period there. Okay, so that is Chapter 22, which is really Homeowners Insurance Part 1. Upcoming Chapter 23 is going to be the Homeowners Insurance Part 2. And I look forward to talking to you then. Thank you.